Good morning, everybody. I want to make a special announcement, and I don't usually do, but I'm very happy to do it. You might not all know Jennifer Golden, who was with ComCenter for 8 years as our part-time bookkeeper, and we have induced her to come back as our full-time bookkeeper, not only to do the bookkeeping for ComCenters, but to be available right here at 70 to help our own clients with bookkeeping, because we have lots of small businesses who have light bookkeeping help required, and they're not too swift on it. And a small business really ought to be out there in the marketplace getting customers. And so that's another service, and you'll be hearing more about how we can help you be more productive. But just wanted to say hi, Jennifer. Thank you for coming back, and we're in great shape.
Thank you, Bernie. Thank you, Jennifer. And thank you, Joanne, for coming today. We're really excited to hear what you have to say, so let's get started.
Alrighty. Well, first of all, thank you all for joining us. This is obviously a little earlier than most birds are out, so to listen to someone who alleges to profess about tax at 7:30 in the morning is impressive, if nothing else. So, that being said, my name is Joanne Kuntz. I'm an attorney and CPA. My primary practice areas are real estate, corporate, and tax. So my primary function is to help people buy and sell businesses and to run their business as tax efficiently as possible. Keep in mind, tax evasion is illegal. Tax avoidance is perfectly legal. So I'm in the business of avoidance, which is great. What I have put on the desks are just a little handout. I don't intend to read to you. You're all perfectly skilled at that. This is more something for you to take with you for reference. If you have, it's going to sort of summarize everything that I'm going to say. I'm from New York, and I'll talk fast, and I will just talk until you leave. So if you want to say something, you just have to interrupt me. That's perfectly acceptable. What I try to do, for those of you who have seen me speak before, I try to be pretty interactive. So I don't want to talk about stuff you don't want to hear about. So I have a whole packet, and I'll never get to all of it, so I'd rather talk about what you'd like to hear about. One of the things that I like to kind of start by doing is, whenever we've got a crowd like this, obviously you all are in some way, shape, or form involved in small business or self-employed. How many of you are actually operating versus how many of you are thinking of opening a business? Is everybody operating already?
Yes.
Pretty much everybody. Is anybody operating with an LLC or partnership or some kind of entity? Is anybody not operating with an entity? Not everybody raise their hand, so you got to pick one. It's like being pregnant, yes or no.
I have no idea.
You either have an LLC or you don't.
A lot of us are employees.
A lot of us are employees, so we're not liars. We're just in the middle.
Yes.
Okay, that's great. I never know, because sometimes I have liars, and I just need to know that. Since we have no non-liars, and since we have no one who's not an entity, then I won't bore you with the why you should be an entity, because you've already cooperated, which is fantastic. That's not usually the case. What you'll see on the top sheet of your handout is the business menu. What that is the choices that you can make when you decide to become an entity. You can be an LLC, you can be a partnership, you can be a corporation, and all of those things have pros and cons. Is everybody an LLC, or is there anybody who is a corporation or partnership?
I got both.
We have both. What are you?
Corporation.
You're a corporation. What is your both? What is the other one, a partnership?
One's an S Corp and one's an LLC.
Okay, we'll talk about that. And you're running a corporation. What kind of business are you running?
Insurance.
Insurance. Okay, perfect. The reason that I ask, oh yeah, one more.
I have 2 different corporations with DBAs.
Okay, perfect. That's also another spin, so thank you. The reason that I ask is people oftentimes don't know what the differences are. And with an LLC, we just have a little bit more flexibility. If you have a corporation, you're required to hold an annual meeting and to keep minutes from that meeting. If you do not observe those corporate formalities and something were to happen, you end up in court. The judge says, all right, you wanted to be treated like a business. Let's see if you acted like a business. If you haven't observed your corporate formalities and maintained your minutes and held your meetings, you could run into some trouble with having the liability protection, which is exactly what you're seeking by having that corporation. Interesting thing that you've said is I have an S corporation. You are taxed as an S corporation. Your company is not an S corporation. So underneath that tax election, you've got to be either an LLC or a corporation or a partnership. That's something we hear commonly. I'm an S corp. It's not a thing to be, it's a way to be taxed. Why would anybody be an S corp? Does anybody know?
Pass through taxes.
Right. So we want to save the employer portion of the self-employment tax or the payroll tax. There are some businesses which should not be an S corp. Anything that holds appreciating property, like real estate, trademarks, patents, anything that could go up in value, we don't want in an S corp. So if you've got your rental property, S corp, absolutely not, under any circumstances. Last time I gave this and you were there, somebody was like, oh yeah, my rental properties are all in an S corp. I'm like, who told you to do that? I was hoping he said he just did it on his own, but he didn't. So that's something that can cause some wrinkles down the road. Yes, sir.
I didn't hear what happens to you if you're so foolish.
Well, what happens is a big fancy tax phenomenon called built-in gains tax, which is essentially a non-cash transaction that generates a bunch of tax. If you sell me shares in your LLC tax as an S corp that owns appreciating real estate, it's like selling part of the real estate. So you recognize that gain when you sell me the stock, but you didn't really get any money, so you don't have any money to pay the tax. So there's a phantom income that's not very pretty. I would say it is malpractice for me to allow someone to put appreciating real estate, and even down here where you're
That's
not always
Florida.
certain it's going to appreciate.
It's Florida, it's malpractice.
I know.
Heaven.
I'm not saying it's a deep pool. I'm saying there's a pool. We try to keep people straight and narrow. So with the S corporation, the other thing I tell people is, even if you don't believe me about the built-in gains tax, the primary reason, as was suggested by our friend here, for having the S corp is to save the self-employment tax. But guess what? Rental income, by definition, is passive income, meaning it's not subject to self-employment tax. So there's no benefit to committing the malpractice, which is even more interesting. You don't even save any money. I don't want to bore you with technical tax topics. I want to keep this a little bit more surface level, but those are the kind of things that people don't necessarily realize are out there. And if we don't know, and we're just operating our business because it's busy and you're trying to keep up and you're trying to keep the customers happy, these are the things that can go by the wayside. One of the things that Bernie mentioned with having bookkeeping available, that's one of the very first things that people run out of time to do. I cannot strongly encourage you enough that is the absolute most important part of your business. If you're doing all the work and you're not accounting for the money, you're overpaying in tax or you are under collecting from your customers. Both of those mean you're working for less money. The whole point of coming here is more money. If you want to do something for free, go to Siesta Key. There's no reason to volunteer. Another big no-no that I see inside of businesses where people get busy is we start commingling our funds. Does everybody have a business debit card linked to your business checking account?
Yeah.
Yes, does everybody use it for business expenses? Sounds like a dumb question, but you wouldn't believe the number of people who whip that thing out when they're at Publix. Why? Why are we doing that? You know what the most common answer I hear is? Why did I pay a personal expense with my business account? That's where the money was. I had money in that account. Really? The online banking allows you to transfer the money, do it as an owner draw, and put it from the business account to the personal account, pay the personal bill. The vice versa is true as well. Lots of times I have a client recently who we were doing the year-end wrap up, preparing the tax return. I give him the tax return and he's like, advertising is way low. I had put an ad in the Observer and that ad was $7,000. But my advertising expense for the whole year is only $6,000. Okay, well, was the bookkeeper supposed to be Kreskin the Amazing and just know that, or were you going to give her the receipt? Because he paid for it on his Amex card. Amex is the bane of my existence. Why is that? People want points. I don't know what's with the points, but people want them badly. Badly enough to miss business deductions because you pay on your personal card for a business expense like the big advertising bill. And then what do? You pay the bill and you put it in the file. But you don't put it in the business file, so the person who's handling the business books has no idea that we just spent $7,000 on an ad. Can't deduct it if the bookkeeper doesn't know about it. What if the bookkeeper's you? Well, guess what? You're busy running the business, you're trying to keep up with the customers and get the product out the door, and you forget. So even though you mean to, and I'm gonna put it in there, it's just easier if you keep the business expenses on the business card and the personal expenses on the personal card. What other issues can come from it? Again, if we're not acting like a business, we won't be treated like a business. So somebody falls and breaks their neck in the comm center, and they say, well, Bernie, you're liable because you didn't have the floors repaired and it's your fault that they fell and broke their neck, and now you have liability. And you say, but I'm a business. Okay, well, all this commingling, I can't tell the difference. The business appears to be an alter ego. I can't tell the difference between you and the business. So therefore, I won't protect you like a business because it's just your alter ego. So if liability doesn't scare you into cooperation, maybe overpayment of tax will. If you've missed your deduction for the $7,000 in advertising, your tax bill will be higher. Dead silence means either you're bored to death already or scared to death. What am I getting?
Little both.
Little of both.
No, just scared to death.
Okay. Are you guys having any of these kind of issues? And this is a safe place to come to confession. I'm not going to tell on you or beat you, but is anybody struggling with, well, how am I keeping them separate? Or I end up, my contractors a lot of times end up at Lowe's or Home Depot and they don't have the business card on them and they're in Venice and the card is in Lakewood Ranch. Do I expect you to drive all the way home just to get the card? No. If there are one-off situations where you just end up in a pickle, fine. I want those to be accounted for, but I want them to be anomalies, not 3 times a week. I want them to be a couple times a year. And that will cover the time when you need to spend big money and you want the Amex points. So we can be friends on the Amex, right? Anything that you're running into that concerns you, that you're not sure if it's okay, that you're any situations in your own businesses where you're like, I wonder, based on anything that I've said, if you have a problem or not.
All right, I'm going to throw this out. So
I love you.
I'm
It's
guilty
safe, I promise.
I'm guilty of all the above.
Okay, good. Most people are guilty of the commingling, whether they admit it or not.
So I have my cap one that gives me 2%. And
Okay.
I pay for everything on that.
Okay,
My shops are Publix.
okay,
And my business expense. And at the end of the month, I separate out the personal expenses and I just account them as shareholder withdrawal.
okay.
And
Mine's set up automatically to do that. If we do that, when I put it in, it just comes in QuickBooks. It automatically goes to the shareholder draw for personal.
Okay,
And this way I don't miss any business expenses. And
That's
it's
fine.
It's easier for me to handle that way.
I'm okay with that so long as we're actually allocating to shareholder draw, where that usually falls sideways and what I'm talking about where we won't receive the protection in the event of a catastrophe, and it is where a lot of people want to forget to allocate to the shareholder draw and want the Publix to be entertainment or client expense or advertising, right? Laugh, but it happens all day long. Some of my favorite questions that always come up around, April 14th when everyone wants to come into my office are things like, well, how much am I allowed to deduct for charitable contributions? Well, how much did you give? Well, what's the maximum? The maximum is what you gave. How much did you give? This is not like a number that I make up. I love also when people give me the Goodwill receipt for all the junk they dumped off, and they're like, okay, well, you just tell me how much that is. I don't know. Did you give them Gucci or did you give them Target? I don't know. So I don't know how much the jeans were. That's kind of your
RJ.
Exactly. This is another $2.
Add it on.
But for the commingling, that is what's critical. Most people who do use one card for everything do not allocate out to shareholder draw, which does cause a problem. Yes, sir.
I had a client with a small construction company, one card, and he would go to Costco and buy a couple of things for business, slide tapes and stuff, and do the family shopping, one receipt, and he turned that in as business expense. And I told him that's probably not going to fly.
It's a horrific idea. A, from an accuracy of accounting standpoint, but more importantly, think about what happens when we come up for examination or audit with IRS. You're sitting in front of the IRS auditor, and let's set the stage. I mean, these folks are not, since the Bible, people have hated the tax man, right? So, this is nothing new. The jokes are just sort of progressing as the stories become a little bit more absurd and who's on cocaine publicly, but whatever. So the situation becomes you're sitting at the desk with the IRS examiner, And he says, okay, let me see whatever line items they're auditing you for. And what they're going to pick on you for depends on what type of taxable entity you are, and we can chat about that in a second. So let's say they're looking at advertising. And they say, okay, well, you've spent for this year that's under exam, pick a number, $25,000 in advertising. I need to see your invoices and checks showing that you've paid those invoices. So you pull $5,000 payable to, Herald Tribune. Here was my ad at Christmas time. But then you start, okay, there's 5,000 of the 25. Where's the rest of it? And the rest of it is onesie, twosie, Costco, because I bought,
Paper.
a yard sign, and then I bought, grapes and pineapples and steaks. When they see that receipt and see that you've deducted the full amount, your credibility immediately goes in the tank. The auditor is then interested in seeing many, 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 many more things. If I can then substantiate, if I sit down with the same auditor and the same questions and I throw $20,000 of the $25,000 in invoices with paid checks, they don't even want to see the rest. And that may get them off of the other categories that they're even interested in. To say, you know what, your records are in good shape. People often fight with me about what do I have to keep records on? Things like per diem, meals and entertainment. What do I have to turn in a receipt for? The more the merrier, because again, when we sit down with the examiner, the better your records are. It's sort of like when you're in third grade. The better your handwriting, the more likely you get a better grade. No matter what kind of garbage you put on the paper, if someone can read it, it's probably going to score better. It's the same thing with IRS. If they can see something, it goes better. Mileage. You're required to keep a mileage log. For my folks in the contracting industries, for my realtors, they hate me when I say that. Is it inconvenient? Of course. Are there apps for it on your phone? Absolutely. If you have a old school spiral notebook in your glove compartment, that works too. There's more than one way to skin the cat. I'm sorry that it's inconvenient, but you're required to do it. Why do people fight me on it? Because very seldom are you audited. Only 1% of tax returns are audited annually. When is it a problem? When you're audited. It's kind of like insurance, and plug your ears if you do insurance, because I'm going to laugh at you now. They don't cover anything when you need it, right? That's sort of generally the proposition that people take. The people up north are like, I didn't know my basement wasn't covered on my insurance policy until it flooded. No one asked the questions ahead of time, and then they just want to be mad at the insurance guy. Well, you didn't tell me. Well, you didn't ask, and you certainly didn't listen when I tried to tell you what it did cover, because nobody's interested, right? This is what I feel like. I try to say, here are the things that are going to get us in trouble, and no one listens until we're sitting in front of Mr. IRS. Some of the taxable entities receive different treatment when it comes to being selected for exam and when it comes to the scrutiny you receive while you're under exam. I love S-Corps. Sometimes the IRS does, and sometimes they don't. They actually tell us as practitioners which entities they're targeting each year. They will come out and say, this year we're looking at partnerships. This year we're looking at S-Corps. Particularly reasonableness of compensation, particularly this, that, or the other thing. I can tell you some things are certain though. Some things are year in and year out. I can have you put the exact same dollar amounts on a Schedule C tax return of a 1040 and put those exact same numbers on an S-Corp return. And the S-Corp return is less subject to audit than the Schedule C. Why is that? Does everybody know what a Schedule C is? Schedule C is the self-employed form that goes on your 1040 when you haven't elected to be treated as an S-Corp or a corporation or a partnership. Mostly single-member LLCs or sole proprietorships that are unincorporated. Your Mary Kay people, sometimes realtors, independent salespeople, hairdressers oftentimes.
Should they be S-Corps?
The only reason to not be an S-Corp in an operating business is that you have more than 100 shareholders. You have a partner who is foreign for tax purposes, not immigration purposes, or you absolutely adore paying an additional 7.5% in income tax.
So she should be an S-Corp.
Absolutely. Let me caveat that with, I would also say that there is an increased cost in preparing an S-Corp tax return as opposed to throwing a Schedule C on a 1040. So the savings in tax should outweigh the additional cost of the return. So if this haired person is only making $20,000 a year, 7.5% savings on 20 grand.
Claims that much. She made a hell of a lot more than that.
That is a different issue.
Yeah.
You don't want me
Listen,
praying.
I know.
I'm not the right guy to be in church,
She
but
uses her business account like for everything.
Oh, goodness. Well, it's more expensive for me to fix it than for me to...
We have a good CPA who rips his hair out every year.
Oh, there you go. So, see, we love it. We love it. And then those are the people who also come in on April 14th. We really love them. The bill is higher. That's how we show our love. Thank you for coming April 14th, and thank you for bragging to your friends about it on Facebook. Your CPA loves you. I don't know why people do that. Like, you're not getting the A+ like product on April 14th. Like, I'm dead, not a gas, and I want to go to the Caribbean. Like, you'd rather me do your return in February or March. But nonetheless, so back to our friend with the hairdressing. We want to be sure that we are not only accounting for all of the expenses, but doing so properly. And like I said, when we are running the expenses through the S-Corp, for some reason, well, I know the reason is, you are less likely, according to IRS and statistically, to be untruthful in your categories on an S-Corp return. So they sort of believe you more, if you will, on things like advertising, rent, utilities, meals and entertainment, if those things appear on the S-Corp return as opposed to the Schedule C. Why is that? Statistically, S-Corp returns are prepared by tax preparers and not by yourself on, hnrblock.com or, taxact.com or something like that. What you will find in the self-prepared programs is advertisements that say we have a, Aaron Rodgers style discount double check on your tax return. At the end of preparing your tax return on this program, it will tell you if you've missed a deduction. Do you know where that comes from? Do you know how it knows if you missed a deduction? IRS has an algorithm called the differential index function. The diff calculator is how they pick you for audit. It's the variation that you are from the normal in your income range. So let's say, for example, you make $50,000 a year. The IRS will compare you to other folks who make $50,000 a year. And literally, it does a graph to see your outliers. If you make $50,000, how much do you spend on mortgage interest? How much do you spend on real estate taxes? How much in medical expenses? How much in charitable contributions? The more you are outside of those norms, the higher your likelihood for audit. They also look at categories. If charitable contributions are out of whack, that's more suspicious than things like mortgage interest, which are reported to them by the bank. So it's easier to lie on charitable contributions. Other things they look at are the occupation that you put on the line next to your name. Joanne Coons, attorney. Guess what? Audit risk goes up. They hate us. I don't know why. I mean, everyone does, but thank God for TARP, and now they hate the banks worse than the lawyers. That was awesome. So there are some industries that they look at, and at-home sales is one that's a little bit more elevated on the audit risk. If you have these expenses and you happen to be an attorney or you happen to be one of the higher risk categories, am I saying don't take a legitimate deduction? Absolutely not. But let's be papered, let's be documented, let's actually have records that aren't all on commingled, and being prepared for that is going to make life a lot easier in the event that we need to defend those expenses. If we can, however, save tax and reduce the likelihood that somebody's going to question us about it, why would we not do that and take the S election? Like I said, the only reason to not elect an S corporation for most types of businesses is you've got foreign investors. So our friends from Canada are still foreign. Our friends from England, although the accent's beautiful, are still foreign. And like I said, that's a tax test for residency, not an immigration test. So your partner may not have a green card, but may still be a foreigner, for tax purposes. So if that's the case, they can't hold an S corp. But otherwise, I just tell people, if you're not an S corp, you just love paying tax.
Even over an LLC?
The LLC is the vehicle that you are. It's the entity that you are. The S election is how you're taxed. If you take a peek at the menu, that first page on your packet, you'll see you have choices of entities. Those are the different kinds of ways you can incorporate and be a business. On the right-hand side of the menu, you have choices of taxation. Those are the ways that you can talk to IRS about your income. Pretty much all of those cross. So you can be a single member LLC, taxed as an S corp. You can be a corporation, taxed as an S corp. You can be a partnership, taxed as an S corp. The left side is what the state of Florida recognizes. That's what happens when you go to Sunbiz. That's what you are. On the right-hand side is how you are taxed. So you can be an LLC and be taxed as an S corporation. What you cannot be is an S corp. It's not a thing. The state of Florida doesn't know what you're talking about. Go ahead.
What's the difference between S Corp and C Corp? I've heard something about that lately.
The difference between S Corp and C Corp is, A, C Corps were first. They come from subchapter C of the Internal Revenue Code. Same thing with S Corps. They come from subchapter S of the Internal Revenue Code. That's also why the state of Florida doesn't know what you're talking about, because they don't operate inside the Internal Revenue Code. They operate in the Florida statutes. LLCs are Article 608 of the Florida statutes. That's not S Corp. You'll hear C Corps be termed as double tax. What that means is if you're running a C Corp, the corporation would report income, expenses, and therefore net profit. The corporation on its tax return would pay tax on whatever that profit is. It would then distribute the profits to the shareholders. The shareholders report that distribution as income on their tax return, and they pay tax again. So that $1 of profit got taxed on the corporate tax return, and then let's say 70 cents of that dollar flowed through to the partner, to the shareholder, and the shareholder paid tax again. So it got taxed, the same dollar got taxed twice. Why would anybody pick this?
Large employees?
You have more than 100 shareholders, publicly traded companies, or companies that existed before the S Corp legislation was passed. What if you're already stuck being a C Corp? Can you change to an S Corp? Absolutely. Is it a good idea? It depends. It depends what kind of assets you've depreciated in the past. It depends what kind of things have gone on in the past. You might have some tax due as a result of the conversion. Is that a bad thing? Not necessarily. If the tax due to convert is comparatively to what you'll save in the years going forward, worth it, then yeah, pay the tax and let's convert. It depends. It's not necessary in all cases that we close the business down and form a new business. There are a couple things that we can do to try to lessen that tax or spread it over time if that's an issue. But most people who are a C Corp are either improperly a C Corp or have no choice. Those are usually the only two reasons. The S Corp is what you've heard in the beginning some folks refer to as a pass-through. What that means is the S Corp provides its own tax return to IRS on Form 1120-S. It reports its income, shows its expenses, and shows its net profit. But you'll see underneath net profit, no tax paid. It distributes the profits to the shareholders on the Schedule K-1. The shareholders report the profit on their personal tax returns and pay tax there only once. So it passes through from the company to the shareholder, and that's where the tax is paid, and that's where that term comes from. That's what it means to be a pass-through entity. One level of tax, and if you are an active investor, meaning you didn't just put money into a business that you never touch, you'll save the self-employment tax, the 7.65% self-employment tax, the employer portion. For my employees sitting there, when you get your paycheck stub, you'll see that you have FICA and Medicare and your federal tax withholding coming out of your check. On the other side of that, your employer is paying those same payroll taxes, not the federal withholding, but the payroll taxes. If you are self-employed, you are paying the employee share and the employer share. And what I'm talking about with the S Corp allows you to save on the employer side. Yes?
Just hanging.
Oh, you're just waving at me.
Yeah, how you doing?
Thanks for keeping me awake. Yes, sir.
Thank you. I notice you don't discuss nonprofits in this coverage because you're talking about taxes things, but is that a plausible dodge?
Well, in order
Dodge.
in order to avoid tax, that is not usually. In order to be a nonprofit, you have that's a completely different ball of wax. But if you just decided to set up your law firm as a nonprofit adventure, folks would be to see you. Folks in suits would be to see you. No, and there's a whole separate rules for accounting. It's a completely different animal. The reporting requirements are different, and you generally
start as a C Corp and then request nonprofit.
Oh, not necessarily. Well, the way that you go about it is different. You really the physical organization can be anything. The physical organization can be an LLC, but you have to tell Sunbiz that you're going to be a nonprofit, and then you do your 501c application, C3, C6, depending on what you are, and those are back to the Internal Revenue Code designations. you mostly would hear about 501c3s. Those are charitable organizations, churches, educational foundations, things like that. But then there are separate subsections for like the Fraternal Order, the Eagles, and the police benefactors, and those kind of, they're all different numbers, but it's basically the same thing. You've got to qualify to have a reason to be a nonprofit and to be exempt. Anything else? Head spinning? Are we learning? Are we not happy?
Feel good?
Are we uncomfortable? You better not go to the auction. You're going to buy a lot of stuff.
I do.
Questions on anything else? Nothing at all. I've done a really good job. I don't believe that. So types of entities that we pick are going to depend on what the purpose of the business is, what the nature of the business is, and what your goals are. Some people want flexibility. Some people want control. Some people want majority control of the decision making, and how you do that and how you structure that is going to be different in each type of company. So when people call me and they say, well, what's the best thing to be? My off-the-cuff, off-the-shelf answer is, unless you've got a weird business or weird circumstances, off the shelf, I would recommend an LLC, taxes, and S Corp. But there are certain situations where that's not the best advice. So we need to know what you're doing and why. Some people say, you know what? I want to open a pizza shop. Why do you want to open the pizza shop? Well, because I really like pizza. Okay, that's probably not the best way to pick a business, is by your hobbies. I certainly wouldn't own a shoe store. Wouldn't be good. But more importantly, what we want to make sure is that when we go into that kind of business, oftentimes my guy who just likes pizza has a bunch of money, and he just wants something to do. That's fine. But the partner better be somebody that's done nothing but pizza his whole life. I grew up in it, I grew up in restaurants, and I know the business. So oftentimes there's a money person and there's the execution person. They don't always want to be 50-50 partners, right? So the guy with the money might say, I want 70% of the profit. You're actually doing the work so you can have 30, but this would never get off the ground without my money. Those types of arrangements where it's not going to be 50-50, sometimes we need to look at how we're going to tax it. Sometimes they want to be 50-50 for ownership, but not 50-50 on the profits. If that is one of the goals, can't be an S Corp. S Corps must distribute profits and losses in the same percentages as the ownership. So if we're 50-50 owners, we have to split profit 50-50. What do we do if the people want that? Make them a partnership. Because in a partnership, we can be 50-50 partners, and I can take 70% of the profit. And let's say I can't use those losses. I've got trapped losses from other businesses. I can give you 80% of the losses. I don't want them adding up on my tax return, and there's more value to you, guy who knows how to make pizza. So I'll give you more of the losses. It'll help you on your tax return more than it will help me. Those things are great when we're negotiating, the partnership in its inception. Sometimes people come to me and the business is old. I've been running my business 15 years. But they just kind of figured out that they haven't done anything since they started the business. It's kind of like never doing anything with your car since you bought it. Maybe we should have an oil change. Maybe we should have a tune-up. A lot of times folks will bring the business in for a tune-up. Let's see what's going on. What kind of documentation is in place? Oftentimes people think that I just sell operating agreements because I have nothing to do and need to earn money. I kind of think operating agreements are just helpful. The operating agreement is sort of the bylaws of the LLC. They're called bylaws in a corporation. They just have a different fancy name under the LLC. If you are in business with someone else and do not have an operating agreement, does that sound like a good idea?
Nope.
Why not?
Stuff happens.
People are crazy. The reason it's not a good idea, it's kind of like dying without a will. As long as you want your stuff to go how the state says it will go, it's fine to die without a will, right? But if you kind of want your stuff and your kids and your money to go to certain places that the state may not have contemplated, then you probably should have a will. Same thing with your business. As long as, if stuff happens, you're okay with what the state says happens to your business, you're fine. You don't need an operating agreement. How many times do you think that you want what the state says would happen?
Never.
Very seldom. Like I said, for LLCs, Article 608 of the Florida statutes governs what happens. Do you have any idea how long that statute is?
Like everything else in the government.
About 4 pages. 4. You have any idea how many things can go wrong? More than 4 pages. So, for example, I just like war stories, so if they're boring you, tell me and I'll shut up. For example, my clients, of course, are always as pure as the Iowa snow. They never do anything wrong, so this example will continue with that. I have a client. She did not want to pay anybody to set up the LLC. So she decided with her best friend that they were going to open a business. And they said, you know what, these lawyers are crazy, and why would you pay anybody? And so they just went to Sunbiz, and for $138, and in about 10 minutes, they had an LLC. Awesome, now what? They buy a franchise, they open a toy store. These were 2 stay-at-home moms who decided a toy store was what they wanted to do. Nobody thought that retail at Christmas time would be atrocious. So, August, when we open, everybody's happy, everything is great. Come October, partner B has disappeared. This is for the birds. I have little kids. I can't be gone in the evening, which is when the retail store is busy leading up to the holidays. So, guess what happens? My lady is still stuck at the store, working the hours, and now has had to hire somebody to work when the partner was supposed to be working. Well, we don't have an operating agreement, so what happens? She just abandoned the business. She stopped contributing financially. She stopped contributing in time. She's completely abandoned her interest in this company. How do we get rid of her? The operating agreement would tell you how to get rid of her, but we don't have an operating agreement. So what do our 4 pages of Florida statutes say? Nothing. Nothing. You have no obligation under the Florida statutes as a business partner to come to work and to care about the business. That is not required. Acting in bad faith, not an issue. Running another toy store, not a problem. Do you think it's in my operating agreement? Is it a problem if somebody runs a competing business that's your business partner? Absolutely. Non-compete rules don't apply. Nothing. There's nothing in the Florida statutes that says you have to be a good partner. So how do we get rid of her?
Dissolve the corporation.
You can dissolve, but in order to dissolve, we have to have her signature. How else can we get rid of her?
Buy her out.
Bingo. Guess how much that costs?
A lot.
A little bit more than the operating agreement. Our final buyout was $25,000 to make somebody go away who never cooperated after 2 months in. Took 3 years. Total, not 3 years. She didn't come see me in the beginning, of course. But it took her 3 years to get this lady out of her hair and cost her $25,000. Any idea how much an operating agreement runs?
500.
Bingo. You tell me you can't afford one. And of course, this is like insurance. I'm only telling you stories about when things go sideways. If everybody kisses and hugs and it's kumbaya for 15 years, you're right, you wasted $500. But the likelihood of that happening when people are involved with money is not high. I've seen it all. I've seen parents embezzle from children. I have seen employees steal. I have seen, you name it. I literally think I've seen it all. And I've only been doing this for 8 years. I don't think you could hit me with one I haven't seen. I also had a company that was buying and selling alligators that was an ice cream shop. So I see sometimes non-pertinent business functions in the QuickBooks. Like, why did you sell an alligator in the ice cream store? I'm kind of confused. Apparently the skin is very valuable. So it was a purse. So eventually. That I understood. The actual selling of the physical gator I was confused by, but the actual purse I was on board with. So the reason I'm saying that is when people come to me and they want to start the business, there's a couple places that people want to pinch the pennies. And they don't want to spend money on these agreements because to you it's something that just sits on the shelf. You're right, it's insurance, it's in case of emergency. But if there's an emergency, imagine your car without insurance. It's not often that you drive to work every day and don't expect to have a wreck, but when there's a bad one, you're really glad you have it, and that's really what the purpose of that is. The operating agreement will outline the terms, not only in case things go wrong like that, but really to prevent issues from arising inside the company. How do we make major decisions? What are major decisions? Some companies, that's a whole section that I put in there. How do we vote? How do we make decisions? How do we decide if we're going to allow Wendy to come into the company? That's something, a new member should be unanimous consent. You shouldn't have to be involved in business with somebody that you don't want to be in business with. But on the other hand, I don't want to set the company up for stalemate so that everybody has to agree to everything or you'll never get anything done. Yes?
So if you don't have a partner, is there that much value in a partnership agreement? I just throw that out.
Sure.
Thank you.
On a couple of levels, maybe. If you don't have a partner, do you need an operating agreement? Maybe not, unless you intend to at some point have a partner.
Yeah, what happens if you suddenly get an partner?
Yeah, well, it's oftentimes a much better idea for you to already have an operating agreement that they get to sign a joinder to rather than the two of you negotiating the agreement, because the terms are on they're your favorable terms as opposed to what you've had to come to terms with. More importantly, if you're going to sell the business, to another company, oftentimes those take place over installment sales, so you might be in a transition period with a new owner on the way out. But mostly, it's if you're going to bring somebody on in the future. The other concern, and this is starting to go away, there was a case that the Florida Supreme Court heard called Olmstead. And Olmstead has put LLC law on its head. There was a period for about the last 2.5 years where it could be deemed malpractice of me to allow you to form a single member LLC for collection purposes, for outside liability purposes. So one of the reasons we'd form an LLC, as we talked about earlier, is protection from liability. I crash my car and I want someone to take my business assets. If I screw up in my business, I don't want them to take my personal bank accounts and assets. Olmstead was an anomaly case where, like I said, typically, if the bad action happened inside the business, they can't usually come after you personally and vice versa. Olmstead was bad facts make bad law. What do I mean by bad facts? I don't think if the circumstances of that case were different that the judge would have held the same way. It doesn't matter what I think. The Florida the Florida legislature is working on changing the LLC statutes. So, a little bit of background is, in the Florida corporate statutes, for corporations, not LLCs, completely different category of statutes, there is a provision that says a debtor or lender can get what's called a charging lien against your shareholder. So let's say you and I are in business together, and I rack up a bunch of credit card debt, and I don't pay it, and my credit card companies start chasing me and want the money. They can sit in my spot as shareholder for the purposes of receiving distributions to get paid back, but they can't vote, they can't run the business, they can't act in my shoes as the shareholder and make decisions. Why is that? Why should he have to be in business with a credit card company? If we run a pizza shop, how does the credit card company know anything about pizza? So to protect you, the legislature said, you know what, if Joanne owes money, just the only thing the lender can do is stand in the shoes to receive the money. They forgot to put that portion in the LLC statutes. It doesn't say that in a multi-member LLC that there is only the right of a charging lien for a lender. So, what comes up in Olmstead is a situation where this character sold gift cards, if you will, mostly to old people, all through Florida, double-digit millions of dollars. These gift cards were sold like they were Amex or Visa gift cards that could be used anywhere. However, they were good only in a 5-page pamphlet of junk. Like you can buy this coffee mug and this key ring and that's it. There was this really small booklet of things you could buy with this gift card. But he didn't sell them that way. So he defrauded all these old people, took millions and millions of dollars and shoved it into a single member LLC and said, hey, LLC, I'm liable, LLC isn't, you can't take the money. The court's not going to reward that kind of behavior and protect the LLC, right? So if this wasn't a situation of fraud and the guy really had a legitimate debt, do you think they would have really let him inside the LLC? Probably not. What was the argument of the court? Hey, if the legislature was worried about protecting people, they would have put it in the statute. They didn't, and they did over here, so that must mean they actively decided they didn't want to do that. The other argument that the judges took was, in a single-member LLC, there is no you to protect. Can't protect you from yourself. So the point of the charging lien was so that the other innocent party didn't get stuck running a business with somebody they didn't know. There's no other party in a single-member LLC to protect. What does any of that have to do with what you said? What it has to do with it is having an operating agreement in a single member LLC is one of the factors that's considered if there is a creditor protection situation going on. If someone's chasing you for money, and can they get inside your LLC to get the money? Depends. Operating agreement is one way to protect that. So yes, it's important if that's a concern.
Build a firewall around.
Absolutely. Yes.
One of us wants to start a new venture development or business, wants investment capital from partners, but we want to keep that person passive and retain operating control. Could you compare the limited liability partnership with a general partner corporation with simply LLC?
Absolutely.
Can you do it?
You can accomplish
either
the
way?
same thing. You can accomplish the same thing. The only difference is that LLC would need to elect taxation as a partnership, just like the partnership would by default. What he's asking is typically LLCs have only been around for about 20 years. That's why there's so much upendedness in the law, because it hasn't all shaken out yet. Whereas corporations are much older, so the court cases have siphoned through to say what will happen in the event that the legislature didn't write a law to say what would happen. So people used to use partnerships, and they would have a general partner who was sort of the main company that's really, really running the business, and then there would be limited partners that really aren't involved, just threw money in to make it go, and they're going to get paid if this thing takes off. That used to be how we structured those things. What he's saying is, can we put those into an LLC now and get rid of all these different partnership structures? Yes, you can. But we need to tax it as a partnership because, again, we don't want to, depending on how many people are getting involved, we may not be able to be an S-Corp. There may be foreigners. And sometimes those percentages may not go according to the ownership. So you may say, look, you've got a 2% ownership from a voting standpoint, from your right to make a decision, but you're going to get 30% of the upside if this thing pops. That would have to be a partnership financially in order to get that done.
Can the LLC have a corporate managing partner, or does it have to be an individual?
Yes, the LLC can be managed. This is a really great point. Thank you. The LLC can be managed one of two ways. There's what's called member managed, and there's manager managed. Manager managed LLCs operate like an outside board of directors in a corporation. They're not necessarily owners. This would be the corporate manager. It's somebody that you trust, that would make business decisions, but is not necessarily an owner. Have you all been on Sunbiz? When you see the owners at the bottom listed, this is MGR. At the bottom, you'll also see MGRM. That means managing member. Managing members are owners who run the company themselves, like a corporation without a board. How do you think when my clients who set up their toy store picked the difference between MGRM and MGR? How do you think most people pick that?
Yes.
Thank you. Completely random guess, because nobody knows what it means. That is a huge election that you're making. What I really love is some people will put both. They'll put you as MGR and you as MGRM. That's impossible. You are either manager managed or you are member managed. You, when you put that, try to purport that you're both. It's hilarious to me. What's even more hilarious is people will go to LegalZoom and then pay LegalZoom to go to Sunbiz. LegalZoom tells you we cannot dispense legal advice. You are literally paying LegalZoom to go to Sunbiz and type. I cannot think of a more atrocious waste of money. Tom Brokaw used to say the fleecing of America. That is definitely one of the biggest scams I've ever seen. God bless Robert Shapiro for thinking of it, because I'm sure he's making more money than I am. But he's literally telling you, I can't give you advice. But you can pay me to go to Sunbiz, which you already do. You already know how to go to Sunbiz. The problem is, what do you pick when you get there? And you're not done when you get there. So great, you formed your LLC, you paid your $138, boom, you show up the next day on Sunbiz. Now what? With no operating agreement, with no written consents, how do you get your bank account open? How do you get your tax ID number? Do you need sales tax? Do you need an occupational license? Do you need tourist development tax? Sales tax is interesting. Anybody in here sell a thing, a tangible product, or is everybody in service?
service.
You have a product? What do you have?
We're a marketing firm, but we.
It's perfect.
So we.
So sometimes
we
you
sell
have
a
sales.
variety. We sell. I do consulting. I sell digital products like websites, and then I also sell physical, tangible products like promotional products,
Perfect.
T-shirts, hats.
Perfect. How about you?
Printing.
Okay. So one of the things, just to kind of give you an example of how absurd sales tax is, I like to play a game. Is it taxable or not? I'm a graphic designer. You're starting your new business, and I do your logo. Sales tax or no sales tax?
No.
No, tangible product should be taxed.
Anybody feel differently?
It's a service.
Intellectual property.
Depends how I deliver it to you.
I don't show sales tax.
It depends how I deliver it to you. If I email you the logo, EPS, no sales tax. If I hand you a CD or a jump drive with the logo on it, sales tax. That's the difference on whether it's a tangible
That's what
product
she
or
did, is
not.
why I picked 10.
It's silly.
Yeah.
But I'm saying people are running their businesses just guessing. Like, oh, that doesn't sound like it would have sales tax. Really? Because guess what? The state is broke. So there are whole departments of auditors who are just looking at different kinds of businesses that are really, really ripe to have weird transactions like that. I just did a sales tax audit for a communications company. They install wiring, like the Cat5 wiring and cell phone towers and all sorts of crazy stuff. And my guy's been in the business for 30 years, and he knew everything inside out and backwards. Until he got the audit, and he fought with the auditor for about 6 months before he retained me. And he's telling the auditor, my cell phone towers are attached to the building, therefore they're fixtures, and therefore they are exempt from tax based on this code. My guy was on it. I mean, more than the average bear, knew the code, knew what he was doing. Great, he won on that battle. We literally got down to the nitty-gritty, and it turned into, well, the wiring that you attach inside the wall. When you attach the thing, because I never did actually understand what all of the things were, but go with me technically. When you attached the thing to the wall, did you pull the wires out of the wall, or did you put the thing in the wall? Because that was a deciding factor on whether or not it was taxable, because that determined if it was part of the fixture or not. These things were so specific. I have another company that does cabinets, kitchen cabinets. Fixture, that was what he thought. Not always. Depends. Are you selling to the builder? Are you selling to a homeowner who already has the home and now you're remodeling? Are you paying sales tax? Are you collecting resale certificates from people that you're not charging sales tax for? There's a whole menagerie of ways to have a problem there. And it's a lot of times things people don't realize. People get up and running, you move around, you move your business, never looking into what the local requirements are. My office is in downtown Sarasota. I'm required to have a city and county local business tax registration. Do you know what the local business tax is? It's just a fee. They used to call it an occupational license. There's a big fight over whether something is a license or a tax. My local business tax for the city of Sarasota is $14.43 a year. You know what the penalty is if I don't pay it?
A lot more,
$500. Do you know why anybody would not pay $14.43?
because they don't know about
Bingo. Just because they don't know. Do you think the Department of Revenue is interested in, I just didn't know? As a sort of an excuse? No. It's an expensive mistake to make. So this is why I'm saying a lot of times people have an existing business will kind of come in for a tune-up and say, hey, is there anything out of whack? Is there anything I should be concerned about? Because you're an expert in your business. You know how to do marketing or kitchen cabinets or hair or whatever the business is. I'd hire my own lawyer when I did some of my stuff. A lot of things, I'm good at lawyering, not at certain other things.
You would think that people would try to avoid taxation by not charging sales taxes where they should, but I bet you find there's a lot of businesses who charge sales taxes when they should not.
Definitely. You know who is most guilty of this? Restaurants. Restaurants who have private parties or functions for nonprofits. Let's say I have an Italian restaurant and I bring in the entire Sarasota Opera comes in before they perform. It's an exempt organization. They shouldn't pay sales tax. Oftentimes there will still be sales tax on their check. And they've overpaid the sales tax.
You talk about the importance of succession.
What's going to happen to your business when you aren't here? For some people, the business goes away. A lot of times lawyers, solo practice lawyers. If I'm not here, who's going to come? I have other people on my staff, and my hope is that there will be life after me. But for some people, realtors, things like that, the nature of a professional business oftentimes is that the business will go away if the owner goes away. But oftentimes when you've got businesses that are conducive to it, the business could continue. And oftentimes folks want the kids to continue the business or other family members. And if so, or key employees. You have a guy who's been with you for 30 years and you want him to take over when you retire. That is something that can be leveraged, particularly with non-family employees. Plans can be set up. Key man life insurance policies need to be put into place so that there's money to buy out when something happens to these owners. Tax planning needs to be done. There's a whole lot of issues with succession planning to make sure that not only does the business turn over and remain viable and continue to be profitable and the customers don't disappear because they actually know the people who are taking over, but that you do so in a tax efficient way and that you do so in a way that will motivate the people who are taking over to not just sit there and wait for the cash cow to come and then blow the business up. Protecting that legacy also can provide you cash stream after you're not working, residuals or things like that. People don't necessarily want to think about that. It's kind of like the estate planning thing, nobody wants to talk about their own demise, but it's not even necessarily demise so much as you just might want to back off and spend more time in the Virgin Islands. And there are ways to do that with insurances and with other agreements to make that happen effectively and efficiently. And it's not inexpensive advice to receive. I would suggest that it probably pays tenfold. Agree, disagree?
The issue too is, okay, you're in business with your partner because that partner brought something to the
table.
Partnership. Mm-hmm. And does that mean that you necessarily want to be in business with that partner's spouse or that partner's kids?
Right. And that protection as well. And that's why I'm suggesting the insurance policies. You want to be able to pay the wife to go away when the husband dies. You don't want to have to deal with her and have her in the business. Again, those terms are going to be outlined where?
Operational.
Thank you. What happens when I die? What happens if I'm disabled? What happens if I'm ruled incompetent? I fall off a ladder and I have a massive brain injury. Do you think my CPA partner wants me to still continue to practice? Do you think she wants my husband involved? Good God. We'd all be in trouble, especially the clients. So those kind of things, we also throw provisions in there for divorce. What about bankruptcy? I don't want the business getting pulled into these types of issues. And you don't necessarily, like you said, you want to pick your business partners. And just because John's good at it doesn't mean Mary's going to be good at it. If there aren't the assets to make her go away, and the operating agreement doesn't provide for some kind of payout, and how do we value that payout? I die tomorrow. What's the business worth? Who's going to decide that? How many appraisals are we going to have? Are we going to hire a certified business valuator and pay 10 grand, or are we going to just take the average annual sales over the last 3 years? That should all be agreed to. Oftentimes there are things people don't think of. So we're in a rush to pay our $138 and get our business doors blown open. It's not what people want to think about in the very beginning. I'm not saying it's wrong. But particularly as the business grows and as the business acquires more value and goodwill and other intangible assets, it's really something to think about. Yes?
Is it a fair question to ask you to expound on why do we get into an audit? Why would the business get into an audit? What types
Sure.
of things trigger that?
Absolutely. Sometimes it's just dumb luck. Play the lottery. 1% of returns are examined annually. Like I said before, IRS does sort of promulgate what they're interested in. Sometimes they get hot and heavy on reasonableness of compensation for S-corps, and I'll get into that in just a second. But they'll pick an area where they're all fired up about it. They think there's fraud. They think there's, misstatements in that particular area. The taxpayer advocate's office kind of gathers information and gives it to the IRS and says, okay, here's where we think the risks are. So part of it is they pull about 1% of audits. Now, they have sort of with all the furloughs and all of the financial problems that the government's had sort of backed off a little bit. So they're a little bit more selective on who they pull. But they use that diff function, that calculator, and combine that with abnormal trends. So let's say, for example, this is why a lot of times people don't get nailed right away. Let's say you are lying on your charitable contributions and you say you make 50 grand a year, but you say you give 10 grand a year to your church. As long as you say 10 grand every year, that kind of becomes the norm for you. And so that helps reduce the weirdness of that transaction, right? So what will happen is there will be an anomaly. You switch to TurboTax, and TurboTax says, hey, people who make what you make usually give $11,000, $12,000, or $20,000 a year. So what do? Joe Public, you use the exact number that TurboTax spit out. You don't say $11,812, you say 12 grand even. Guess where TurboTax gets the number?
The IRS.
The same algorithm. It's the IRS's number. So the IRS is onto this, right? This is why you'll see self-prepared returns have a higher incidence of audit than if you come to a tax professional. There is a statistical average that demonstrates that you will lie to your computer more than you will lie to me. Because I don't tell you, hey, you cheapskate, you should have given $12,000 in charitables. Why didn't you? Whereas, and I'm not picking on TurboTax specifically, but any of those self-prepared programs that when they're trying to catch your missing deductions, they're just showing you against the diff calculator. Other things that can cause riskier transactions are things that are ripe for abuse. So what's hot right now? Cancellation of debt income. You've done a short sale. The Mortgage Forgiveness Debt Relief Act protects you from paying tax if it was your primary residence 2 out of the last 5 years and you use the money to acquire, construct, or substantially improve the property. Meaning the debt that was forgiven, the money you didn't pay back to Wells Fargo, was used on the house. Not to pay off credit cards or buy a truck or go to Europe. Okay? Well, guess how you prove that? You complete Form 982 on your tax return and you check a box that says, I qualify under the terms of the qualified principal residence indebtedness exclusion. What do you submit with that? Absolutely nothing. So how easy is it to say, I'd prefer to not pay tax on the 250 grand I just stiffed Wells Fargo. So I'll just check this little box and no one will be the wiser. A lot of people check the box. A lot of people are checking the box perfectly legitimately. But that is a category that is ripe for exam, and it's usually what's called correspondence audit. It's a piece of mail where IRS says, hey, Wendy, I saw you deducted this. Why don't you show me your closing statement? Give me proof that it was your primary residence, and give me proof that that was used as qualified principal residence indebtedness. Show me that was your mortgage amount. Show me it was used to purchase the house, or that in a refi, let's say you bought the house in 2002. You paid $200,000, your mortgage was $190,000. 2005 comes, what happens? You refi that bad boy for $350,000, right? Because why? The bank sent you a letter and said you could take the money. This is my favorite. Be like, I didn't want to do it, but the bank told me I could. Okay, so what'd you do with the 150 grand? Well, I put in a pool and I re-roofed and I updated the kitchen. And my daughter turned 16, so I bought her a car, and then we went to Italy, and I love Italy. I'm not saying that's bad use of the money. I'm saying it's probably not going to qualify under the exclusion. So what they're going to want to see is, give me the receipts for the roof, give me the receipts for the swimming pool, give me the receipts for the kitchen repair, and now pay tax on Italy and the car. That correspondence audit is the end. It's mail. It's literally, hey, show me that you qualify for this. Not scary, you don't get a person, no one comes to your house. That being said, there are a lot of phishing scams going on electronically. The IRS is prohibited from making outbound phone calls, even to me, even to a practitioner. Unless I'm dealing with a local revenue officer, they can call me. That's it. Nobody from Philadelphia, No one from Ogden, Utah, no one from Atlanta is going to call you from the IRS. The IRS does not send outbound email, not even the local office. If I have an auditor locally, they cannot email me. They have email only internal to other IRS workers. If you receive an email that says, we're processing your refund and we just need a little bit of information, it is a scam, unequivocally. There is no exception. There are few things that you will ever hear a lawyer say there is no exception to. There is absolutely no exception. The IRS will not call you. The IRS will not email you. It sort of cracks me up if you're up late at night and you see the commercials for the tax blaster, tax tiger folks that are fighting the IRS. There's one commercial on right now that says, we'll stop the harassing phone calls. I'm like, that's interesting because there are none. The harassing phone calls are coming from Capital One and your credit card companies, not from the IRS, but nice call, tax tiger. So, you know, there's a legitimate way to do this. You will not find me on the radio if you're up late at night. So those kind of things where you see abnormal trends or you are outside the norm in your categories will trigger audits. Also, things that are just categories they don't like. As I mentioned earlier, you see advertising, you see rent, you see utilities, you see meals and entertainment on a Schedule C for a Mary Kay lady, for a realtor even. IRS looks at that with a little bit more suspicion than if we throw it on an S-Corp return. Is that valid? Probably not. But I can put those same dollars on an S-Corp return. The position of the service is, if you've done enough to actually have the S-Corp and you're that organized, you're probably more legitimate. The bookkeeping is probably more in place. The S-Corp is just ripe to throw your personal expenses on it, and that's what they're looking for, are things that are easy to cheat. Mortgage Forgiveness Debt Relief Act is huge. Next year it'll be something different. Reasonableness of compensation is oftentimes something that they look at. It goes in and out of favor. Sometimes they're hot and heavy on S-Corps, and they'll switch their attention to partnerships, but they'll tell you what they're looking at. In an S-Corp, one of the things that I keep mentioning to you is that you can save that 7.65% self-employment tax. You still have to pay yourself a reasonable salary, though. I'm a lawyer running a law firm. I can't say, well, I make $10,000 a year running the law firm, and my distributions and dividends are $300,000. The IRS is going to insist that you take a reasonable compensation. What is reasonable? Well, it depends. It depends on the type of business. It depends on specifically how much time and effort the owner directly contributes to the generation of revenue. So, in personal service corporations like law firms, accounting firms, engineering firms, where there's clearly the revenue coming into my firm is generated by my work. It's harder for me to take a lower salary than my friend in the marketing firm, where you can make money on promotional products, or you can have staff that maybe, you know, is putting together proposals, or, you know, other people in the firm are generating revenue. I have paralegals that are generating revenue, but certainly not in the proportion that the lawyers are. So, if I have a retail operation, that owner could get away with a substantially lower salary than what a lawyer could. Other things that they look into are actual time that that business owner spends in the business, and how many, what the percentage is of wages paid versus distributions. I like to say 60-40. 60% of distributions, 40% of wages. That's not being greedy.
60% what?
To distributions, no self-employment tax. 40% to wages. They want some of that tax. Yes?
If you have a losing year, you can still pay yourself. I mean, can you do it by distributing instead of paying?
Yes. And that's where the percentage comes into play. So if the business only was profitable by $30,000 or something small, yeah, okay, you know, I just took a draw. I didn't take a salary. But if it's $300,000 and you didn't get, it's reasonableness. And
Any rules on 1099 wages?
Lots of rules. What I can tell you is nobody wants employees, everybody wants independent contractors. It doesn't matter how you write the agreement. It doesn't matter what you call it. It matters what the nature of the assignment is, what the nature of the work is. Independent contractor, classic example, is you hire a painter to come to your house. He brings his paint can, he brings his paint, he brings his brushes, he does it on his time with his crew at his discretion.
And you don't tell them how to do it.
You just shut up and pay.
And he's licensed and so on.
Hopefully.
Well,
Florida.
it's Florida, it's a bonus. I had a character, I told you I have stories. I have a character who was paying waitresses in a seedy adult nightclub as 1099 contractors. Really? She poured drinks from your liquor bottles into your glasses. She came to work at the time you told her. She left when you told her. She put the money in your cash register. And you think that's an independent contractor? Really? Not at all. There is not a restaurant under the moon that can claim that a waitress is a 1099 independent contractor. Are there people in the middle? Absolutely. Facts and circumstances test will determine. You just have to be aware of what the nature of the assignment is. I have realtors who have assistants that help them field phone calls, contact, cold call people for listings, things like that. Is the assistant an employee or is the assistant an independent contractor? Kind of depends. Is the assistant working the hours she told you she could work? Hey, I can give you 8 hours a week. I'll work Monday this week. I'll work Thursday next week. I'll work every day 2 to 4, whatever. Or did you say, I need you here every day to cover the lunch break? If you told her when to come, she looks more like an employee. If she came when she wanted, she looks more like an independent contractor. Whose computer did she work on? Did you issue her a laptop or did she bring her own? Did you tell her to sit in your office or did she work from home? And none of those things are locked solid. It's not like being at home is the way to get out of it. That's not what I'm saying. But you look at all of those factors, it's how the more you assign and the more you control and the more you govern the project, the more they look like an employee. If you say, look, I need this camera fixed, take it and fix it and I'll give you $500. Totally an independent contractor. If you start saying, hey, I want you to fix the camera but do it this way and I don't like that and put red tape on the outside, the more instruction you're giving, the more you look like you have an employee. Nobody wants the 1099 contractor to be an employee because they don't want to pay the payroll tax. I'd rather just pay her and let her deal with it. Well, that's great, but that's kind of not the test. Whether you feel like it or not is not really what governs whether they are an independent contractor or not. You also have different tests for the Department of Labor. I'm talking to you from a tax standpoint. I'm telling you what the IRS will say. Department of Labor will feel differently. Their test is more narrow, and if you are not paying folks as employees who are, you will have a different conversation and a much stricter penalty imposed if you violate the Department of Labor's rules. I am not an employment attorney. I consult someone for those things. But from a tax standpoint, that's what you're looking at. Other questions?
What are your thoughts on internet taxing these days?
Amazon.com case is going on right now. There's something called the Amazon tax in the Supreme Court of the United States, arguing whether there's sales tax on internet transactions. Stay tuned.
They're going to tax it. They got to tax it.
Oh, yeah.
Well, for the online retailer folks, I don't know. I mean, I have a little bit of a corrupt view. I just kind of feel like anything can be bought. And if the lobby is big enough, they'll get what they want. I mean, I'm not saying that's accurate. I'm saying that's my personal thought. But, it is the rule that if you order something online from Colorado and you don't pay sales tax, then you have to pay use tax. Well, of course, the retailer doesn't want to collect the sales tax. But a lot of times people just say, oh, I bought online, so there was no tax. That's not true. You might not have paid tax, but it doesn't mean there was no tax. But like I said, they just wrote the amicus brief for the Amazon case. I would say you're going to hear a ruling on that sometime early next year. And everything is kind of in limbo until that comes out.
And that's a state specific, or will that be federal?
No, that's federal. Because it's interstate commerce issue.
Would it preempt the states putting them in?
Yeah.
Let's ran to someone else.
I see battles
sales
coming on
tax,
that.
even though we're not required because that's the right thing to do.
Well, it's just safe. What happens is if you collect sales tax when you weren't supposed to, it's oops, thanks for the bonus. If you fail to collect sales tax and you owed it, good luck going back to the customer who you should have charged and who would have paid it. And if you owe it, you personally owe it plus penalties and interest. So a lot of people say it's just better safe than sorry. I'd rather have over-collected sales tax and reported it than try to go back.
Sales tax will go to the state that the product was purchased by.
Correct.
Do you have any thoughts on home-based businesses? They used to be kind of high risk, but it's with the internet and so on.
It's more and more common. What I can say about things like that are, again, reasonableness. You know, if you have a home-based business and you are generating only $10,000 a year in revenue because you only do it part-time, and you have crazy huge meals and entertainment expense because you every time you go out to drink with your buddy on the golf course, you put it in the business. You know, if the meals and entertainment are almost as much as the revenue, you got a problem. And laugh, but people do it. I'm like, really? Advertising? Now, if the business is new, I have a guy who just bought an $800,000 catamaran. And he's going to use this boat to allow realtors to rent the boat to take high-end clients to view waterfront properties. This will not be inexpensive. The boat was $800,000. So depreciation is going to be enormous. He is getting the business up and running. He is going to the Ritz-Carlton and seeing the concierge and letting other people know that the sailboat is available for charter. Those legitimate business expenses with no revenue? Absolutely. Do I still want to see him having expenses and no revenue 3, 4, 5 years from now? Absolutely not. So is he going to have a huge loss? Yeah, depreciation on that thing is not going to be cheap. But it's a legitimate, we have advertisements that we've kept to show, hey, here's where we offered this boat for charter. You see the same thing with rentals. Oh, well, I took all the expenses from this other property that no one ever rented. Well, did you advertise it? Did you put it in the paper? Did you put it on Craigslist? Like, put something in the file to show that you actually offered it for rent. The fact that nobody stumbled in and took it doesn't necessarily mean you were involved in a trade or business. You have to be actively engaged in the business in order for the expenses to be deductible. Just because it's home-based doesn't necessarily mean it's not legitimate. It does get a little bit higher scrutiny. So those expenses should be in proportion to the revenue, particularly years into the operations.
Reasonable and defendable, right?
Reasonableness is all I can offer. It goes a long way. It's sort of like, you know, if you have to ask, it's probably not going to work. You know, like, certain things do, but, you know. Any other questions?
Can I go back to LLC, how they're set up? Can an LLC have more than one officer in it? There's just a managing member and...
Officers are different than managing members. So again, you can have officers, presidents, vice presidents, secretaries. Those are not necessarily owners. Those are officers. You can have more than one manager. You can have more than one managing member. You just can't have both at the same time. You can have managing members who have rights to vote with members who don't have a right to vote. That can be the distinction when you're talking about...
Is the managing member sort of like the CEO? In other words,
It depends what the operating agreement says. Sometimes it will say there's 4 managing members. Any one of the 4 of you can act on behalf of the company, can sign contracts, can sell property. Sometimes it will say, you know, at least 3 of you have to sign. Sometimes it'll say all 4 of you have to sign. Or it'll say all 4 of you have to sign for a transaction over $100,000. Or all 4 have to sign if we're buying real estate. Sometimes those major decisions are unanimous requirement based on dollar amounts. So, for example, if I've got the hair salon lady, she might say, if my partner's going to spend 10 grand, I want to have to agree to that as well. But if I have a restaurant, their bar tab's 10 grand. I'm going to shut that place down if everybody has to sign every time they spend 10 grand. They're spending that at Gold Coast. So it depends on the nature of the business. For some folks, it's based on, you know, are we going to buy real estate? If it's a restaurant, if it's a Chinese restaurant and they want to, one of the partners says, you know what, I think we should change and we should be pizza. Change in concept is a huge issue that everybody should agree to. So what the managing member has the right to do is going to be governed by the operating agreement. If there is no operating agreement, they can do whatever they want. Because Article 608 of the Florida statute says the managing member has the discretion to decide. The other issue that you run into is actual versus apparent authority. You have hired a manager to run your restaurant. And he has generally had the apparent authority with your vendors to order beer, to order food, to order to boom, boom, boom. He goes sideways and you fire him. What does he do? He, of course, places a huge order for perishable food so that you get stuck paying for it. So what do? You call Cisco and you say, I fired him and he didn't have the authority to order that. Well, did you jail anybody at Cisco? Because he was allowed to order for 3 years. If you didn't put people on notice, hey, this guy doesn't actually have authority, but he has apparent authority, people would perceive that he has the authority to do so. You're on the hook for the bill. So when we go to get rid of folks, we need to do some background work. Not only electronically and cutting off email and computer and things like that, but with outside folks where they might be able to spend some money. Some things are returnable. Usually hundreds of pounds of tomatoes are not. Other issues. These are good questions. At least you're awake.
I have a good question.
Sure.
For the entrepreneurs in the group that have, multiple businesses, what are the advantages of having multiple corporations as opposed to DBAs under corporations?
Spreading the risk. So sometimes, and you'll see this with not only different kinds of businesses, but with folks that have rental properties. Sometimes people say, I just want to have one LLC, I'll put all my rental properties in there. The more stuff inside each entity, the more cross-contamination you have for risk. So if I'm running a pizza shop and a clothing store and a nail salon, all under one corporation with DBAs, if something happens in the pizza shop, all the assets of the other businesses are up for grabs. The DBA, or the doing business as, or fictitious name registration, simply allows you to legally identify that particular business with a different name. Sometimes it's a shortcut. Sometimes, you might be Kuntz & Associates PL. If I accept checks under the name K&A, I should DBA that. Because if I just let you always write your checks to K&A, 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 I'm not holding myself out in that business, and if something happens, that can be a problem for me legally. The other issue that comes up with DBAs, and this one really cracks me up, because again, people want to do things themselves. And I get there's a whole channel, DIY Network, do it yourself. But what do they do on there? Usually paint bathrooms and remodel and refinish decking. They don't usually do legal documents on that channel. And there's a reason. There is a reason. So what happens with my friends who go to Sunbiz, because Sunbiz is really easy to use. It's like QuickBooks. It's really easy for you to make a mess. So you go to Sunbiz and you do your fictitious name registration, and there's a menu and you click it and it says, I want to be a DBA. And you click it and you pay, and it's $50. And you say, I want to be called Blingin' Things. Okay. What do? You sign up, you enter your information, you pay your fee, you click a box, and you say accept. What's in the box? Do you know? The box is an acknowledgement that says you understand that in order for this DBA to be effective, there is a requirement that you advertise in a newspaper the use of this DBA prior to filing this application, and I hereby certify that I have made said advertisement. How many people who do it themselves do you think actually advertise in the newspaper?
Nobody.
Why not?
Didn't know about it.
Why not?
It's never checked.
Because they didn't read the box.
Get rid of it.
You just checked a box that said you did it, and you didn't do it.
But
So-
nobody ever checks
Right?
if you did do it.
Until there's a problem. And then they go, oh, that DBA is not even registered properly because it wasn't advertised, which means you held yourself out under that name, which means you weren't operating under the business, which means you weren't protected, and therefore you're personally liable.
Is there a way to correct that after the fact?
Yeah, you can re-advertise. You can like if you did your DBA 5 years ago and you just now realize, oops, I didn't advertise. You throw it in the newspaper right now, you're covered from now on. Somebody complains from, an accident that happened 3 years ago but was still within the statute of limitations, you're still pregnant.
I've gotten involved in a situation where a vendor had a conventional corporation named XYZ Corporation, state of Florida. But in their contract documents, they just said XYZ. XYZ will do this, XYZ will do that. And then down at the signature block, it was XYZ Corporation. Are they breaking the law when they do that, or is that just a minor wrist slap?
What I would want to see is that in the opening paragraph it says this agreement is entered into between Bernie and XYZ Corporation, parentheses, quotes, XYZ. And then if they refer to themselves as XYZ throughout the document, I'm okay with that. If not, no, that's another ding, and you're not acting like a business. You're not using your proper name. Your business cards, if you are an LLC, need to say your full business name, comma, LLC. Even if you're running out of space, even if you make it 4-point font, it needs to be on there. And that's oftentimes why we'll DBA something. Somebody has some big, giant, long name, and they say, look, we just want to be known as something shorter. Then DBA that something shorter. Put that on your name tag. Put that on your business card. Put that on your signed real estate agent.
Whoa, I'm a real estate developer. I offer signs to my clients, and they want this big, long Bible on there.
Mm-hmm.
And
It can be in negative 2-point
People
font.
driving by 55 miles an hour are not going to see what you are.
Right.
They say, yeah, but my lawyer said.
This lawyer says just make it small. There's a reason there's that print you can't read. It just has to be there. It doesn't have to be legible. It just has to be there.
Unless you're in the securities business.
Then there's a different ballgame. Not even going there. But those kind of little nuances, is any one of those things going to get you thrown completely out? No. But the totality of the circumstances will. So you're not using the name. You're commingling your assets. You're not accounting for things properly. You're not, doing your minutes. You're not. The more you're not, the less likely the court's going to protect you in the event that something catastrophic happens. And of course, I'm talking in the event of something really major, not something minor. And this is, people say, oh, I have insurance. I don't need an LLC. I have insurance. Okay, insurance is like long underwear if you're going skiing. I still think you should probably wear a coat. It's a great layer of protection, but it's not the only protection. For the insurance people in the room, plug your ears. It's no secret that they often try to deny claims. Maybe even legitimate claims just to frustrate you to not pay. Okay? So you can fight with them. You can try to get your coverage reinstated. But in the meantime, you've still got liability to the person that was injured. So they're still going to pursue your assets. They're still going to go after you. Whereas if it's protected in the LLC, you're a lot less attractive because all that's up for grabs is whatever's in the LLC. So if it's a rental property and the only thing in the LLC is that particular property, my bank accounts, my assets, all of my other valuable items are not up for grabs because they're mine, not the company.
Except if you sign a person's guarantee.
Personal guarantee limits you only to the bank, though, not to...
Or certain vendors will make you...
Yeah, but you're liable only for those things, not for something catastrophic. Yes. Okay. I hope that I have not scared you out of business, but I'm happy to answer questions if you do have any, and I hope that it's helpful. Thanks for coming.
Dan, thank you. It's made my head spin a little. Thank you for all of that, and that was just great. Thank you so much.
Thank you.